Short exercise 6-4, FIFO inventory costing method. So this problem is the same as the previous problem, except in this case, the company uses the FIFO inventory costing method. FIFO stands for first in, first out. So let's say a company purchases some merchandise at one cost, and then later they purchase more inventory at a different cost. So when they finally sell some inventory, which one do they sell? The one that came in first or the one that came in last? Well, since they're using FIFO, first in, first out, the inventory that they're selling is the one that came in first. So start by preparing the beginning inventory balances. Enter the transactions in chronological order as in the previous problem, calculating new inventory on hand balances after each transaction. Once all the transactions have been entered into the perpetual record, calculate the quantity and total cost of inventory purchased, sold, and on hand at the end of the period. As always, enter the oldest inventory layers first. So we have to enter the balances as of July 1st. The company started July with 25 bicycles at $36 each. So we're going to bring down the 25, 36, for a total cost of 25 times 36 equals $900. So that's their beginning inventory. And by beginning, I mean the beginning of the month, which is July. Now on July 16th, they have some purchases. Montana bought 35 bicycles at $60 each. So we're going to bring down the 35, bring down the 60. That gives us a total cost of 35 times 60 is $2,100. Now over here in the inventory on hand columns, we have to list our inventory. Now remember the instructions said enter the oldest inventory layers first. So this is the previous layer, so we have to bring that down first because that's the oldest layer. We would call this the $36 layer because that's how much it cost us each. So 25 times 36 gives us 900. Now we had to bring over the new layer of inventory, the $60 layer. So we're going to bring over the 35 quantity, $60 price per each, and the $2,100 total. So as of July 16th, they have two layers of inventory, a $36 layer and a $60 layer. Now on July 31st, we're going to make a sale. It says on July 31st, Montana sold 33 bicycles for $105 each. Now remember, this $105 is the price. Price means what we're charging our customer. This inventory record is only showing our costs. So we're going to ignore the $105 price at the moment. So first of all, let's work on the quantity. We sold 33 bicycles. So we have to figure out, are we selling the ones that cost $36 each or $60 each? Well, the key is this company uses FIFO inventory. So the first ones in, which is this $36 layer, are sold first. So we have to sell 33 of them. However, there's only 25 of them. So the most of these that we can sell is 25 at a cost of $36 each, for a total of 900. All right, so we sold 25 out of this 33. So how many more do we have to sell? Well, we're just going to subtract. 33 minus 25 gives us 8 units. So 25 plus 8 gives us the total of 33. Now how much, or what was the price per each of these 8? Well, that has to come from our second layer of inventory. So these cost us $60 each. 8 times 60 gives us $480. So the total cost of goods sold for the July 31st transaction is $900 plus $480. So $1,380. We will need that information later. All right. Now we have to figure out, well, how much inventory do we have on hand after this sale? Well, this 2,500 layer, or excuse me, the $36 layer is sold out. So that doesn't exist anymore. We do have some of this $60 layer left. So we had 35, we sold 8. So you subtract those two numbers to give us 27 units remaining. How much do they cost? The $60. And the total cost, to calculate that, it's going to be 27 times 60. So 27 units times $60 each gives us $1,620. So if our supervisor asks us how much inventory do we have as of the end of the month, July 31st, we've got $1,620 worth of inventory left over. And remember, the $1,620 is what it cost us, not what we could sell it for. We don't know what we can sell it for until we actually sell it. Now we're going to bring down our totals. So let's work on the purchases column. We purchased $35 for a total of $2,100. Now let's work on the cost of goods sold column. How many did we sell quantity-wise? We sold 25 plus 8 is 33, which matches this 33 up here. And what was the total cost of goods sold for the whole month? Well, 900 plus 480 gives us 1380. And then how much is our inventory left on hand? Now, you can't just add up all these because these layers of inventory were for different dates. We only can go back to our last date. So our last date, July 31st, we had $27 quantity, and they cost $1,620. We check our answer. There we go. Now we're going to journalize. Journalize a July 16th purchase of inventory on account. So that's what we're doing right here. So on July 16th, this transaction here, we purchased 35 at $60 each for a total of $2,100. So remember, in the journal, we don't have quantity or price each. We have the total cost. So it costs us $2,100. That will be my debit and credit. Now we have to figure out, well, what's the debit? Well, we're purchasing inventory on account. So let's figure out what's happening to inventory. Inventory is an asset. Is the asset going up, which would be a debit, or is it going down? Well, we have more inventory, so it's going up. Therefore, inventory is going to be the debit. Now, do we pay cash for this inventory, or is it on account? It's on account. That means accounts payable is involved, which is a liability. So do we have less liability or more liability? We have more debt, which is liability. So that's why it's going to be the credit. And then we need an explanation. Purchase inventory on account. Next, July 31st, sale of merchandise on account. So up here it gives us our detail on the transaction. We sold 33 bicycles for $105 each on account. So are we getting cash or are we getting AR? We're not getting cash, so that means we have to record AR, which is an asset. Do we have more AR or less AR? Our customers owe us more, so that's why AR is going to be the debit. Accounts receivable going up. How much is it going up? Let's see, 33 bicycles times $105 each gives us $34.65. Now, what is the credit going to be? So don't forget our directions up here. It says we're going to record the sale portion of the transaction. Do not record the expense related to the sale. So whenever we sell inventory or any type of merchandise, which I guess is inventory, the first part of the transaction is going to be either cash or AR and then sales revenue. So let's look at sales revenue. So when we sell this, do we have more revenue, which would be a credit, or do we have less revenue? We have more revenue, so that is why we're going to credit sales revenue. And the explanation is record a sale on account. And then the second transaction, we're going to update our expense and update our inventory. So now it says journalize the expense related to the July 31st sale. Review the perpetual inventory record you prepared in requirement 1. And as I mentioned before, if this is a test, they're not going to give you this link because this link shows you the answer. So on the test and the pretest, you would have to scroll up here to find this information. So it's asking us, we need to record the expense. So when we are selling expenses, when we are selling inventory, what is the expense associated with the sale? It's a cost of goods sold. And for cost of goods sold, which is an expense, do we have more expense or less expense? We have more. So cost of goods sold is the debit. Now we have to figure out how much is that cost of goods sold for the July 31st sale. So let's go to July 31st. We go to our COGS. So here's our COGS. Got 900 plus 480. That's $1,380 of cost of goods sold. What that means is those bicycles we sold, they cost us $1,380. Unfortunately, we sold it for a lot more, $34.65. So we have a gross profit. Now this $1,380, we need a credit account. So what happens to inventory when we sell our bicycles? Inventory, which is an asset, do we have more inventory or less? We have less inventory, so that is why I'm going to credit inventory. To record cost of goods sold. And that's it.